All right, so this video I'm going to talk a little bit about the general procedure associated with estimating the cash flows for a capital budgeting project. When estimating the cash flows for a capital budgeting project, we have a couple different kind of categories here. So first, let's look at a new expansion project. If I have a new expansion project, what I'm typically looking at is a purchase of a new asset that's going to have new cash flows. So a new asset that would be expected to increase sales, increase maybe cost savings, maybe increase various expenses. So a whole series of new cash flows associated with a new expansion project. So it's all about kind of new cash flows for that. So in that case, you have to look at, if I do this particular project, what are those new cash flows? Let's quantify those and then put them together to calculate the overall cash flow per period that we can then use in our capital budgeting analyses. If you're looking at a replacement project, this is replacing an existing asset with a new asset. So if you had an existing asset, there were cash flows associated with running that asset. When I replace it with a new asset, then some of the cash flows would have continued had I done nothing. Now I have different cash flows because I have a new asset. So what I have to compare is essentially what would the cash flows have been under the old asset? What will they be now under the new asset? And what's the change? So for instance, if I had an old piece of equipment that I was depreciating a small amount per year because it didn't have a lot of value, and it was late in its life and so forth. So if I'm depreciating that asset in this old equipment and I replace it with a new piece of equipment, which I will also be depreciating, if I had done nothing, I would have kept that old equipment. There would have been depreciation. That depreciation would have lowered my tax bill. If I buy the new equipment, there's now also depreciation, which also lowers the tax bill, but I'm not going to count the entire decrease in the tax bill due to that new equipment's depreciation. The reason for that is, had I done nothing, there would have still been some tax savings because I was depreciating the old equipment too. So what you have to look at in that case is, what was the depreciation going to be with the old equipment? What will the depreciation be now with the new equipment? Let's find the difference, and the impact that difference has on the taxes is going to be the impact that we care about for the purposes of estimating the cash flows of this choice of replacing that old equipment with the new equipment. If, for instance, the old equipment is producing a certain level of revenues, the new equipment is expected to produce more revenue. Well, I don't count the total amount of revenue for the new equipment. I have to count the additional revenue relative to the old one. So when we're looking at a replacement project, it's all about what are the existing cash flows that are happening on an annual basis, and what are they going to change to with that new equipment that I'm going to use to replace that old asset with. So it's really kind of a relative valuation. We're looking at, relatively speaking, what happens to the cash flows when I replace this old piece of equipment with a new one. Now, when you're evaluating a capital budgeting project, typically there are sort of three broad categories of cash flows. You're going to have some kind of initial investment outlay. So this is basically your year zero cash flow. You spend money to buy the equipment. You may also spend money at time zero to perhaps account for a change in net working capital. You could also have a cash inflow due to a change in net working capital. You might have, if it's a replacement project, you might have a transaction at time zero where you sell the old piece of equipment and have to account for tax impacts and things like that associated with that sale. So those are the kinds of things that you're looking at for that initial investment outlay. Then year by year after that, you're going to have your typical operating cash flows each period during the investment's life. And these are going to be the normal revenues, cost savings, various expenses, accounting for depreciation to figure out taxes, and then adding the depreciation back. So you're going to have a whole process, and you're going to follow that year by year throughout the project's life. And those are going to be the operating cash flows that we're going to have to find. Then at the end of the project's life, you're going to have some additional terminal cash flows. Those are additional cash flows that happen basically at the end of the project's life because we've terminated the project. So among them would be, we no longer need this machine. We have used it all up. It does very, very little life left in it. So we haul it out and we sell it for scrap, right? So we the salvage value. Well, if I sell it, then I have to figure out how much I sell it for relative to what was it worth on the books, because that affects taxes, because it could produce a gain or a loss on the sale, and that affects taxes. So I have to look at that. I am also going to have to look at if selling this equipment produces any kind of effect on my net working capital and the levels of net working capital that I have to maintain. So that would be possibly something that would show up as a terminal cash flow. So ultimately, you have basically that initial cash flow, the things that happen kind of year by year, and then you have some extra unusual cash flows that happen at the very end of the project's life, typically. And that's how things generally work out overall when evaluating the cash flows associated with the capital budgeting project. Hopefully this video has been helpful. Thank you so much for watching and have a great day.